Welcome to Plan to Prosper at Yale and Beyond, our inaugural personal financial planning series, co-sponsored by the Yale Club of Washington, D.C., the Yale Alumni Latino Network, and Yale Fin for all alumni and students. Hi, I'm Lisa Chapman, class of 81, MBA from the School of Management and president of 1stGenYale. I want to thank you all for joining us tonight. You represent a broad spectrum from Yale College and the graduate and professional schools coming from across the country and internationally. Over the last 2 years, many members of our 1stGenYale community have been asking us to host a discussion on personal financial management. So we were thrilled to offer this series to you. This is the second in our program, Invest 101 in our series. If you missed our first session, which was held on March 31st, please go to 1stGenYale YouTube channel to see the recording. Now it is my honor and privilege to introduce to you our panelists. Elisabeth Anton, class of 89, Silliman College, is a proud 1st-gen and low-income graduate with an MBA in finance from the Wharton School of Business. Her banking experience is broad and extensive, including Merrill Lynch from London, Credit Suisse in Madrid, and Hong Kong Shanghai Bank in Dubai. She is a licensed investment advisor representative with the Series 7, Series 63, and Series 65. Elisabeth is the founder and president of the Sherwood Financial Group. Our next guest is Philaki Fadomi, class of 18, MBA from the Yale School of Management. So proud. She is a consultant with experience in leading insurance transformations. Philaki serves on the board of the Yale Club of Washington, D.C., and leads the club's Diversity, Equity, and Inclusion Committee. Our next guest is Albert Lee, class of 22, Franklin College, is a proud 1st-gen low-income senior at Yale, majoring in economics and computer science. He works as a paraprofessional in the Sherwood Financial Group. Now I would like to read the disclosure just because it's required. Elisabeth Anton offers security and advisory services through Centaurus Financial Inc., member FINRA SIPC, a registered investment advisor. This is not an offer to sell securities, which may be done only after proper delivery of a prospectus and client suitability is reviewed and determined. Information relating to securities is intended for use by individuals residing in California, Connecticut, Washington, D.C., Massachusetts, Virginia, New Jersey, New York, Maryland, Indiana, and Michigan. Sherwood Financial Group and Centaurus Financial Inc. are not affiliated. 1stGenYale and co-sponsors do not give an opinion or recommendation as to these services. Now it's my honor to turn it over to our host, Philaki Fadomi. Philaki?
Philaki, you're muted.
Thank you. Thanks, Lise. I'm very excited to facilitate the second session. Shout out to the Yale Club of Washington, D.C. members on the call. For those of you who attended the first session, I trust it was an informative session. This session builds on the foundational concepts we discussed, and Elisabeth is going to provide us with insights on how to use investments to grow your wealth on any income. She will start the presentation and we'll have a Q&A session. So please share your questions and comments in the chat, and we'll make sure we get to those once we are in the Q&A session. With that, I'm just going to reach out to Elisabeth. We're delighted to have you present this session. Before you jump into the details, can you share your background and experience while you were at Yale and how that has shaped where you are today?
Gosh, thank you so much. Thank you so much for having me, Lise. I'm delighted to be here. This is an honor for me. Barb, Anne, thank you so much. And I want to give a special shout out to my paraplanner, Albert Lee, with whom, without Albert, none of this would be possible. He is my right-hand man at Sherwood. Let's see. My journey, well, I'll start at the beginning. I was born in the Bronx. to a Cuban, Puerto Rican, Ecuadorian family. My grandparents didn't really speak English, and my father left when I was very young, so it was my mother who kept food on the table, working as an executive secretary for a big bank in Manhattan. I know what it's like to eat lentil soup for dinner 4 nights in a row at the end of the month before a paycheck. We moved to Puerto Rico when I was a kid, and when I got to Yale, I experienced culture shock, deep culture shock on many, many levels. It was then that I became aware, really, of just how poor we were. And I remember feeling very ashamed about it, and tried very hard to hide that. And all I can say is that we just didn't have first gen back then, and we do today. Thank you, Lise. Let's see, when I graduated from Yale, I went to business school. And in business school, I ended up studying finance. That's just because of where I went to business school, really, not because of any particular talent. And I was recruited into banking, and I worked internationally at that point for my entire banking career, starting in London. I think Lise mentioned that. I left banking in 2010 and decided at that point to pursue my very first love, which was writing. I was a very proud English literature major at Yale as an undergrad. So when I moved back to New Haven 4 years ago, it was to pursue a writing project. And when the pandemic hit, I'd been here for about a year and a half or 2 years, and then the pandemic hit. And I'll never forget the day after we went into lockdown, and I woke up feeling sick to my stomach, because I could see how this pandemic was going to devastate the economy, but devastate the communities that are so dear to me. First gen communities, the Latino, I'm Latina, Latino communities. And I thought, oh my goodness, I wish I was a doctor. I wish I was a nurse. I wish I was anything. I really want to help. And it took a couple of days before I realized that actually I have finance skills. And I can help. I guess I decided to open up a little boutique advisory, very focused on anyone who's never had the benefit of advisory. That's my mission. And I work with people for whom personal money management can be sometimes really frightening and overwhelming. And so that's what led me here today. And Lisa's given me this wonderful opportunity to share some insights into personal finance. And I'm very grateful. So I'm here to help you learn how to take charge of your money.
Thank you for sharing your story, Elisabeth. It's great to hear you're back at Yale and your focus is to continue to give back to this community. With that, Albert, we'd like to hear about your journey as well, and any fun facts as we continue to get to know you and engage with you as part of this presentation.
Sure. Yeah, I'm really happy to be here today, and thank you, Lisa and Folake, for giving us the opportunity to speak today. And my story is that I come from 2 parents who immigrated to the U.S. 35 years ago, and I grew up with my brother in the suburbs of Los Angeles. And growing up, it was really difficult for us to pay for electricity bills, pay for different kind of necessities, and I always understood the struggle for money. And when I was little, I would collect cans at my local football stadium and try to recycle to make that extra spare change in order to help out wherever I can. And now as a senior at Yale, being able to understand how money functions and how we can really leverage investing for the benefit of everyone, I really got inspired to join Elisabeth at Sherwood Financial Group and help her.
Great, Albert. Well, we wish you all the best as you wrap up the last few months that you have at Yale. And with that, I'm going to turn it over to Elisabeth and Albert. Please go ahead. We're eager to hear about Investing 101.
Okay, well, without any further ado, so I will go through an agenda really quickly, just to give you a sense of where we're headed. The first thing we'll do is talk about capital markets. You know, when we hear about the stock market, that's really just like a shorthand for what is technically the capital markets. And the capital markets include stock market, bond market, derivatives market. There are many different kinds of markets. So we'll talk about what they are and how they work, why they exist. We'll talk a little bit about how the market grows, what actually makes the market grow. We'll talk about the major investment risks that you face when you're investing in the market. And we'll talk about 4 key elements for managing those risks. They're investment strategies to manage the risk of investing. We'll talk a little bit about what an asset is and what an asset class is, and how that is important for constructing portfolios. And then we'll finish up talking about risk profiles, and we'll tie that into how how one constructs a portfolio according to risk. So that's how we'll move. And first thing I want to show you is that the stock market is at the same time a virtual space in the cloud somewhere, and it is an actual physical space. What you see here on the slide on the right is the New York Stock Exchange, and that actually exists. You can go visit it. And so, but of course, today, way back when, everything took place physically on the floor, as you can see. But now, 95% of all transactions really do occur virtually, right? But what is the stock market? Well, it is a place where companies come to raise money. That's essentially what it is. So if you think of Coca-Cola, and you think that Coca-Cola wants to build a new factory in Taiwan, but Coca-Cola doesn't actually have enough money to do that. And so what it does is it comes to the stock market and it says, I need to raise $1 million. And so it has 2 choices. It can either offer stock for sale. So I, as an investor, can buy a stock of Coca-Cola. And what that entitles me to is a piece of the company. I'm actually a part owner. My share entitles me to a share of the company. Or Coca-Cola can say, well, we don't want to give away any more shares in our company, but we still need to raise money, so let's ask for loans. And that's what a bond is. A bond is essentially Coca-Cola saying, well, if you lend me $1,000 for 5 years, I promise I'll pay it back in 5 years, and I'll also pay you interest twice a year for all those 5 years. And so those are the ways in which companies come to the market to raise money. And it's really that simple. It's really that simple. Oftentimes when I talk to people and I work with people around their money, I often hear a couple of things that I think are a product of not really understanding the market. Myths like, oh my God, investing in stocks is just like gambling. It's throwing your money away. Well, what I want you to come away with from today's talk is that the markets are anything but gambling. What is gambling? Gambling is a zero-sum game where you have to have a loser in order to have a winner, right? And it's winner take all. The loser loses everything and the winner takes everything. But there's not actually, it's a transaction, but there's not actually any value created. It's just transferring money from one person to another. the stock market or the bond market, or capital markets are inherently different because everybody's a winner. It is an opportunity to invest in a project that creates economic growth. So when we're talking about Coca-Cola, for example, and Coca-Cola is going to take the $1 million that it raises on the market, whether through bonds or whether through stocks, and they're going to build that factory in Taiwan. And that factory is going to enable them to increase productivity, to maybe even launch a new product, a new type of Coca-Cola. And that is actually going to feed into our economy. It's going to create products that people want to buy. And this is the fuel of economic growth. So in fact, and everybody's a winner, because when Coca-Cola does so well with the $1 million and increases its profits, guess who is rewarded? It's the investor. Coca-Cola shares its profits with a bondholder by paying interest, and it shares profits with the stockholder by giving dividends. So, you know, I hope that helps clarify the ways in which the stock market are decidedly not like gambling. Some of the other things I hear often is that the stock market is for rich people. Or I hear, oh, you can time the market. You know, you can decide when to go in and when to come out according to like when the stocks are going to be up or down. And I also hear, oh my God, I'm going to lose all my money because the stock market, it crashes all the time. Well, I'm going to show you some slides later on in our chat that will illustrate very clearly why the stock market is not just for rich people, why it is impossible to time the market, and why the stock market doesn't actually crash all the time. Okay, so the growth of a dollar. The growth of a dollar is a very famous graph created by Ibbotson. So his name is Roger Ibbotson. And he has this yearbook, he calls it a yearbook, and it's basically a compilation of economic statistics that he updates every year. And so this has come to be known as the Ibbotson scale. And SBBI means stocks, bonds, bills, and inflation. And these are the things that are being measured in this graph. So if you look at the far left-hand side of the graph, you'll see $1 invested. And a dollar invested in 1926 has grown over the past almost 100 years, 93 years until 2019, into $39,000, 381. Why? Well, that top line, I want you to notice a few things about it. First, it's the green line. I'm not sure you can see the green line, but that's the line that represents small stocks. You can see small stocks over the course of 100 years grew 11.9%. And it equals almost 40,000. We'll talk about what small stocks are, what large stocks are, what government bonds are. We'll talk about that in a bit. Those are asset classes. But for now, what's important to notice is that small stocks have grown the most. Large stocks are the blue line just underneath the green line. And you can see that it too has grown quite a bit, 10%, 10.2% over the past 100 years. And that comes out to about 9,000. The yellow line you can see are government bonds. And we'll talk a little bit about what those are, but you can see those grew much less, 3.3% over those 100 years, and $1 would equal 140, or did equal 159 in 2016. The next thing I'd like you to notice about this slide are the 4 red lines that I put in. And I did that to show more clearly these external shocks that hit our economy over the course of these 100 years. I picked a few that were very familiar. And I picked them so that you could see that so let me start with the first one. The first one is the stock market crash in 1929. That's the first red line. And you can see clearly that the stock market took a nosedive and stayed down for several years. All right. But then you can notice that it did come back up into positive territory. Okay. And the next shock was in 1941, and that's Pearl Harbor. Pearl Harbor happened, and you can see again that the market dipped after Pearl Harbor, but that it quickly came back up. And if you look at the third line, the third red line was 9/11, right? September 11th of 2001. You can see that the market dipped a little bit, but it came back up. And the fourth line is the big crash of 2008, which is the Great Recession that we all lived through. And you can see again that the market dips, but it comes back up. So
Elisabeth, in light of this chart and just knowing that there's so much noise about a recession and the fact that the stock market is hot at the moment and everything else in between, how should we translate all that information and use it to inform, be it how we think about investing and whether or not, now is the right time to jump into the stock market?
Well, I will show on the next few slides what this means in terms of timing in the market and volatility. But the final point I wanted to make here is that these lines that move from left to right in the various asset classes are squiggly. They're squiggly. They keep going up and down and up and down and up and down. And that squiggliness, that's called volatility. And we'll talk about that in a minute. And what I want you to notice, take away from this particular slide in terms of your understanding of the stock market, is that even though these lines are continually squiggly, they're squiggly but trending upward. They're squiggly and they may dip for a few years, they may dip, but they continue to trend upward. And this is how the market produces or creates value in our economy. All right. So I don't know if that answered your question, but ask me again if I don't answer in the next couple of slides. Okay.
Sounds good.
So this slide is about compounding. And I'm guessing that most people are familiar with compounding, but it is the reason why the market grows. It trends upward the way it does. There is a difference between compound interest and simple interest. And the difference is that compound interest is the interest earned from the original principal plus any accumulated interest. So compounding essentially means that you're earning interest on your interest. And that's the big difference between compounding and simple. Simple interest, you're only earning interest on the principal. So if you look at this graph, you have $1,000 that has been invested in year one. This graph is over 20 years. And if you invest $1,000, so you see on the bottom there, the principal remains constant. Well, the next layer up in the blue, that's simple interest, no compounding. That means that we'll just say that this is compounding annually. So once a year it's compounded, let's just say. So you can see that that interest, of course, grows because every year you're getting interest on the 1,000, on the 1,000, on the 1,000, and that interest adds up. But the big difference with compounding interest is that every time you get interest on the 1,000, the next year interest is paid on the 1,000, but also the interest that you've earned. So if this is compounding at 10%, in that first year, right, on 1,000, you will have earned what? $100, right? Is that right?
Right.
Right. So if it's compounded, the next year you'll be earning interest on 1,100, and so on and so forth. And this is the reason why money grows exponentially when it's being compounded. And I want to just say before we go is that this can also work against you. When you're paying your credit cards, and if you don't pay them off every month, right, you're paying compounding interest, which is why it's impossible. It becomes impossible to pay it off when the interest is compounding at 20%, 25%. So there's always, right, the upside and the downside. Compounding interest is fabulous when it's working for you, but it's not so great when it's working against you. So the other myth that we saw in one of the first slides is the stock market crashes all the time. All right. Well, this slide again shows historical returns over the past 93 years. So let's just call it 100 years. And the way we want to read this chart is we want to see on the left side, the market has returned negative returns for 27% of the time. In other words, in the past, let's say 100 years, 27 times the market was negative. If you look on the right-hand side, you'll see that the market was positive. The market ended the year in positive territory. In other words, people made money 73% of the time. So you can see that 2/3 of the time, almost 3/4 of the time, the market is up, not down. And I made some circles here. So you can see on the left-hand side, negative returns. So first, let me define, what is a stock market crash? What does it mean? Well, the stock market, there are 3 different thresholds, and it's, you know, it's not a really important detail, but just so you understand that the market, when it crashes, the first level of crash is like 7%, when all of a sudden all the prices drop dramatically by 7%. Well, when that happens, the stock market halts all trades for about 15 minutes. The next threshold is when all the prices on the market crash to 13% negative. At that point, the market will close for about 2 hours to give it time to recoup. When the market drops to 20%, that's considered a proper crash. And at that point, the market closes for a day, for the whole day. So the reason I circled 1930 is that was the year after the stock market crash. That was after 1929, the Great Depression. And you can see in 1930 and the 1931, both of those years, the market returned negative returns, right, in the 20% or lower category. Proper, serious crashes. You can also see I circled 2008. That was the Great Recession. We came very close to experiencing another depression, and the market crashed below 20% again. But what I want you to take away from this is that the market is positive and very positive. What would I consider the opposite of a crash? Negative 20%, positive 20%. And the market has returned more than 20% 37 times for 37 years in the past 100 years, 37% of the time, right? I circled 1986. Some of you may or may not remember, but 1986 there was a little crash, and I'll never forget because I was sitting in my English class in daily themes in Lindsley Chit, and class started, and I had several of my peers walk in panicking because their parents had just called them because there was some crash. And of course, at that point, I didn't really know what the stock market was. I didn't understand what stocks were or bonds. I really didn't know what anybody was talking about. But I do now. And what I can tell you now about 1986 is that it wasn't even a proper crash. You can see that by the end of 1986, the market finished in a positive territory. So I want you, hopefully, to take away from this slide that the stock market doesn't crash all the time. In fact, it hardly crashes. Okay, so we've talked about volatility here, and I want to talk about volatility and capital loss. What are they? Well, these are the two key types of risk that you have when you invest, right? When you invest in the stock market, these are the two ways which you could lose money. So let's talk about capital losses first. On the right-hand side, a capital loss happens. It occurs when an asset, like an investment, stock or a bond, right, decreases in value. So we just saw that, when prices go down, right, that's a decrease in value. So Coca-Cola, I may buy Coca-Cola today for $100, but next week something happens and now Coca-Cola is worth 85. So that is a capital loss. Okay, when there's a difference between the price you purchased it and the price it is today. It happens with houses, right? You buy a house for $250,000. In 5 years, it's not doing so well, so you have to sell it for $200,000. You've incurred a capital loss. Volatility. Volatility is that squiggliness, right? I think the technical definition of volatility is really big swings. It's not a very technical definition. It's my definition. Big swings, right? Up and down, deviations from the mean. That's the technical definition. Standard deviations from a mean in terms of price. So that means, what it means practically is the price goes up and down. And you can see on the left-hand side, you have stock price. You have two different stocks. One is blue and one is black. They're both worth 100. They were both bought at $100 in January. This is over the course of a year, right? But the blue stock is really volatile. The prices keep going up and down and up and down and up and down. And the black stock is much less volatile. It just does the little squiggly thing. And what you can see is that at the end of the year, they're both worth 100. And so what does this tell you? It tells you volatility is not necessarily a measure of the value of a stock or the value of a company. Okay? There's a lot of factors that go into volatility. And what I want to say here is that there are ways. So volatility comes with investing. There is no real, it's par for the course. So if you're going to become an investor, you need to accept that volatility is part and parcel of the experience. But there are ways to mitigate volatility. And we're going to talk about that. We're going to talk about ways to, essentially, you've got to accept it and ignore it. That's what you've got to do with volatility. You can't react to it. You have to have the stomach to allow you to watch your stock, or hopefully you're not watching the stock, go up and down and up and down and up and down without reacting and wanting to sell, right? Because the moment you sell, now you have incurred your capital loss. The capital loss, when you look at the stock market and the price of Coca-Cola today is 100 and tomorrow it's 85 and the next day it's 102 and then it goes, up and down. Coca-Cola is a bad example because it's actually it's more like the black line. Coca-Cola is very stable, right? You have other stocks that are much more volatile in the tech industry, for example. But if you don't have the stomach For this, well, I'm going to show you how to mitigate that. But you have to make sure that you don't sell when it's low. You have a
So,
question?
Yeah, Elizabeth, I think you're raising a point about not focusing too much on volatility, but what if my goal is to make some quick money, right, from my investments? So my goal is to get some capital gains and then to be able to sell the stock so that, I have some cash in my pocket, so to speak. What would you say for someone like me who's impatient and who has a very short timeline that they're working with?
Oh boy, I would say don't do it. I think if you're working on a very short timeline, let's say you have a goal of making money for a year, or I'm not sure what the time, but successful stock market investing is not short term, Philaki. And so if you came to me and said, you know what, I want to make a lot of money, but I don't have that much time, I would say the stock market is not gambling, and it's not a Ponzi scheme. It requires you to be patient. It requires long-term planning. And I would probably recommend you just get another job, to be honest, to be, rather than try to time the market and lock in gains, because more often than not, you'll end up locking in your losses. And the moment you sell at a loss, that's it. You can never recoup the gain. So I don't know if that's the answer that you wanted to hear, but I honestly don't work with short-term horizons. So that would be, someone that I probably couldn't work with. In all honesty, it's not.
Yeah.
It's just not best practices for market investing. I mean, you have traders, day traders who do things like that. You have hedge fund managers. You have people whose whole careers is watching that volatility and selling quickly and buying quickly. That is a whole different kettle of fish. Okay, so I hope this slide, Philaki, will convince you that you must invest for the long term. Okay, so here we see three investors. We see investor A, investor number one, that's the blue line on the top. Investor B is in the middle, and investor C is the line on the bottom. Okay, so all three investors have invested $10,000 into the market. This is a graph of market returns for 12 years, I think, from 2007 to 2019, okay? In 2007, these three investors invested $10,000 into the stock market. And we can see in 2008, we've just talked about the huge crash that happened, right? The Great Recession started to happen. And you can see on this graph that the stock market crashed, it went down, and now everybody's investment was reduced to half, right? So instead of $10,000, now everybody has $5,155. That's how much value was lost during the 2008 crash. The three different investors behaved differently. They made different choices about their money. Investor A remained committed to a long-term investment plan and stayed fully invested in the stock market. Didn't touch their money, even though they'd lost half of it, right? Investor B thought, oh my goodness, I can't afford to lose more. I've already lost half. I'm going to sell and I'm going to stay out of the market for a year. And then when the market goes better and next year, I'll go back in. Okay, that's called timing the market. Thinking that you can time when the market is going to do well and when it's going to not do well. The third investor panicked so much that said, oh my God, you know, I can't do this. So I'm going to take my money out. I'm going to keep it in cash, and I'm not going to go back into the market. What happened? Investor A's $10,000 that became $5,000 ended up becoming $28,000 at the end of 12 years. Investor B, who came out for a year and went back in, ended up with 18,500. Now that's not terrible, but you can see the difference it made in the compounding. Remember, this is all about compounding, and compounding works if you just leave it in there for the long term. So investor B didn't get as much as investor A, but still made money, right? His 10,000 became 18. Look what happened to investor C. Investor C ended up with $5,431 because they only got interest in their bank account. So I hope that this slide, Philaki, has convinced you not to do that, not to time the market.
Definitely. I mean, the one question that is coming up in the chat is, you know, how long is long term, right? Because the horizon is, you know, for us young gen Yalers, Yaleys, it's, you know, it's a long horizon. So when we think long term, is it, you know, 5-10 years? Is it till retirement? That conversation is happening in the chat right now.
Oh, is it? Okay. Well, I can tell you, I think short term is 1 year, maybe 2. Everything else is long term. So a typical long term horizon would be about 20 years. I think that's a fair amount of time to see your money grow appreciably. But of course, how lucky you are if you have 30 years, if you have 40 years. Imagine what my $10,000 would be worth today if I had invested it when I was 24 and had my first job out of Yale, and I would have saved, let's say, $10,000 or $5,000 and put it into the market. Can you imagine? I'd be a gazillionaire. So I hope that answers the question. I mean, market investing takes patience. It requires discipline, patience, and long-term sort of horizon. You should never, I don't think, invest in the market you know, for retirement, for big goals, for anything less than, say, 20 years before beginning to think about taking stuff out. So unless you have, you know, we talked about this in the last presentation, you know, saving for specific goals often requires different time horizons. And we'll talk about that in our next presentation. But in general, I would say minimum 20-25 years.
Thank you.
I know that seems forever to somebody, to a 22-year-old, right? Oh my God, how old are you at 45? Okay. The next strategy for managing risk is diversification. What is diversification? It means investing in a variety of asset classes. Now, we haven't talked about assets or asset classes yet, so trust me, we'll get to it. But on this slide, I'm hoping that I can do something here to show you how. I'm not sure I can. Albert, can I draw on my slide? Oops, sorry. Albert, can I draw on my slide? I think I can.
Yes, of course.
Okay. All right. So I'm going to try here. Be patient with me. So if you look down on the right-hand side, you'll see small stocks in red. Small stocks, you know, grew. So, okay, I'm sorry. Let me set up the graphic for you. This is, again, a famous graphic. It's called Taking Turns at the Top. And what it is, Morningstar put this together to show how diversification works, how volatile different asset classes are on their own. So on the right-hand side, I tried to match the colors of the different asset classes. So brown is bonds, yellow is large growth stocks like big companies like Microsoft. Green is small growth stocks. Blue is foreign stocks, stocks from the UK. And the red is small stocks and the blue is small value. We'll talk about the assets later, but for now, what I want you to look at is this. Look at where small stocks, how they performed each year from 2005 to 2019, right? So we have, a 15-year horizon here, right? And each year, a different asset class actually performed the best. Let me show you. So here's small stocks, right? Up, down, up, down, up, down, up, down, down. Let's see. Okay. Can everybody see that?
Yeah.
So what does this tell me? So small stocks did really well over these 15 years. Small stocks, they grew 18.55%. That's fantastic, right? But in order to grow in that way, small stocks experienced huge volatility. The volatility up and down and up and down and up. So in 2005, small stocks didn't do very well. They're at the bottom there. What stocks did the best? Foreign stocks. Right at the top, you can see. In 2006, they did okay. In 2007, they did terrible. They're at the bottom there, right? Look at in 2013, they performed almost at the top. 2010 at the top, right? And so the return for these small stocks was pretty good because those investors had to stomach a lot of volatility. Okay, I'm going to quickly do bonds for you. Okay, I'm going to show you what bonds did.
We have 7 minutes left, and I know there are a few questions that are queuing up in the chat.
Okay.
So can we maybe do a quick close on some of the slides, and then we can pivot to questions?
Well, I have about, let's see, I have about 5 slides left. So I can just, start going more quickly if you want.
Sounds good.
Okay, so notice here, bonds are at the bottom, right? They're not volatile and they don't return very much. In 15 years, they returned 3.19%. So this is what volatility is. And this is why diversification is critical, because when some assets go up, other assets go down. And when you have invested in both of those assets at the same time in a portfolio, we'll talk about that in a minute, you're hoping that when one goes up, when one goes down, the other one goes up, and so your portfolio remains unaffected by the volatility. Okay, dollar cost averaging is the other, it's the third risk management strategy. This is the slide that I hope will prove to you that stock market investing is not just for rich people. This is the way that I work with most of my clients in terms of how to enter the market. You don't need hundreds of thousands of dollars. You don't even need $10,000. You don't even need $2,000. If you have the capacity to and the discipline to put money into the market every month, you will be entering into the market using what's called dollar cost averaging. And Dollar cost averaging is the opposite of single lump sum investing. So lump sum investing is what it sounds like. It's if you have $10,000, you invest it all at once into the market. If you're dollar cost averaging, what you're doing is you're investing smaller amounts over time. So it's almost like putting money into your 401k. You take it out of your paycheck automatically, it goes into your 401k. Well, this is what dollar cost averaging is. You take it directly out of your paycheck and put it into your brokerage account, and the money grows. And so this slide here is showing you the single investment strategy, the brown lines on the top. That person is investing $24,000 all at once. And you can see they did that in month 1. This is 12 months, over the course of 12 months. Investor number 2 is investing the same amount of money, but differently, $2,000 a month. So you have, again, right, the blue line is the investor B, who in month 2 invested 15, 16, so on and on. What this slide shows you is that through dollar cost averaging, because you're just in a disciplined way investing the same amount of money every single month, right? You're not paying attention to the ups and downs. You're not paying attention to the volatility. You're just buying in securities every month with your money. And some months, the prices are up. Some months, the prices are down. That's volatility. Well, in those months that the prices are down, you're actually getting a bargain. You're actually buying your stocks cheaper, more cheaply than if you had bought them in the up market, right? And this is the problem with the single lump sum strategy, is that you don't know if you're buying expensive or if you're buying cheap because you're putting it all at once. So I think what I can say here is that if you invest a set amount at regular intervals, you end up buying more shares when the price is lower and fewer shares when the price is higher. And this helps you manage the risk of trying A, to time the market, which we know doesn't work, and B, managing volatility, and C, this is the strategy for those of us who don't have hundreds of thousands to invest. Okay, I have about 4 more slides, Philaki.
Sure, let's do it. So by popular demand, everyone seems game for staying on a little longer.
Oh, great. Oh, great. Okay, well, I want to talk to Albert here. So what can I invest in? This is where we finally talk a little bit about assets and asset classes. So I've been talking about risk, volatility, dollar cost averaging, right? Capital loss. I've been talking about all these concepts, but how actually, when you go to the market and companies want to raise money, well, what do you actually buy? Okay, well, you buy what's called an asset. And there are so many different kinds of assets, but I found a simple pie chart here, and we have some of the most popular assets to invest in: stocks, bonds, collectibles, art, antiques. Precious metals is another way of saying commodities, mutual funds, and real estate. So I'm going to talk very quickly about what each of these are, and then I want Albert to tell me, because Albert is a whiz investor, believe it or not. And he's been doing it for quite some time. And I just wish that I had had this information when I was Albert's age. And Albert's going to tell us what his favorite asset classes are and where he puts his money. But let me quickly I think everybody understands what cash is. Oops. Cash, it's your savings account, your checking account, but it's also money market funds, right? Money market, you hear about money market funds, that's cash essentially, online wallets. What is equity? On the left-hand side, equity is the fancy way of saying stocks or shares in a company. And what is equity? It is ownership into a business. When I buy a stock of Coca-Cola, I am owning part of Coca-Cola. And the way Coca-Cola rewards me for buying part of their company is Coca-Cola gives me dividends on my stocks. And dividends are usually paid about 4 times a year, but they're not guaranteed. All right. Stocks are riskier than fixed income, the next one down. Fixed income is, again, a fancy way of saying bonds or debt. And that, again, is like a loan. I'm not buying a piece of Coca-Cola. I am lending Coca-Cola money, and they're paying me interest on my money. And that interest is guaranteed. So notice, dividends are not guaranteed on a stock. Interest is guaranteed on a bond, and therein lies the difference between why you get much more money when you invest in stocks and less, you're rewarded a lot less when you invest in bonds because it's guaranteed. Real estate is another asset class that we're all familiar with. And, it's basically ownership of a physical space, a house, an apartment, commercial property, land. But it's also, you have REITs. And I won't talk too much, but we'll see it in our next slide. A REIT is essentially like a mutual fund, but based on a mutual fund that invests in properties and collects rents. And so there's a way to buy stock in real estate. And the last one I want to talk about is commodities. What is a commodity? It's ownership of goods that have an end use. That's the definition. And what does it mean? Corn, wheat, soy, crude oil, copper, silver, gold. Those are commodities, and they're traded very, very actively on the market. So Albert, tell me your secrets. What asset classes do you invest in?
Sure. So I would, I think we're going to talk about this a little later, but in general, my risk appetite is pretty aggressive and towards the more, trying to be a little bit more adventurous. So I like to park a lot of my money into equities as well as some real estate. Definitely always good to keep in mind the lessons we learned from the last session, that we want to keep an emergency fund ready for whatever unexpected things may occur. So I like to park some of the cash also into bonds. And so really when I'm parking my money in bonds, I'm trying to protect my money against inflation and other factors that can kind of take away from your savings.
Haha, you see, Albert's already talking about inflation. We're not going to really have much time to talk about inflation, but inflation is, as you know, it's running a little bit wild at the moment, and it eats away at your money because well, I won't go into it, but investing in the market is a wonderful hedge or protection against inflation. Thank you for that, Albert. I'll circle back to you in a minute. So let's talk about what an investment portfolio is. I put here, I hope we all know who David Swensen is. I did not for the longest time because I didn't really know much about the markets. I didn't understand what a brilliant mind David Swensen was. He died just last year, I think in May, and he ran since 1985. From 1985 until just last year, he ran our endowment fund at Yale. And Yale has a very famous endowment fund. It's worth what, 31 billion? How many billions is it worth? Does anybody know exactly? Albert? It's worth, I think around 30 something billion dollars. And that is because of David Swensen. And he basically, in the years between 85 and 2001, he grew our endowment. He doubled it every 5 years. He doubled it every 5 years. This is an incredible feat. So I thought, in homage to David, I thought we would look at the model of asset allocation that he used to grow our endowment. So what is a portfolio? Let me start with that, because we've been talking about portfolios. It's a collection of assets, and stocks, bonds, right? Real estate, international bonds, international stocks. It's just a collection of assets, and those assets are similar, right? Stocks are similar, bonds are similar, real estate is similar, and so the characteristics of each asset class reacts similarly in the market, right? When something happens in the market, well, stocks are going to behave this way, and bonds are going to behave this way, and real estate's going to behave this way. And really, that's what a portfolio is. And so when you begin to invest in the market, you're going to create a portfolio. And in your portfolio, you're going to put different assets. And we learned that diversification is key to managing volatility. So you're going to put assets that are negatively correlated. That's a big word, right? So if one asset, let's say something happens, I don't know, there's a hurricane, and that makes stocks go up. Let's just say a hurricane makes stocks go down. That's more realistic. Well, bonds and stocks are negatively correlated. So what does that mean? It means that if stocks go down, the hurricane is going to make bonds go up. And in this way, right, you are preventing your whole portfolio from going up or down. Because if you're invested only in stocks and that hurricane hits, then your whole portfolio is going to crash. You're going to lose a lot of value because there's not any bonds in there. There's not another asset class that is going to go up and therefore mitigate the loss. I hope that makes sense to you, because it's a critical concept in investing. The diversification of asset classes and making sure that you're picking things that react opposite to each other in the market, just so that when bad things happen, you don't lose everything. You still have stuff that's mitigating the loss. Okay, so that's what a portfolio is. And so I just thought for fun, we would look at what David used to grow our many billion-dollar endowment. He had in the gray on the left-hand side, the gray slice of pie is domestic equities. So those are Coca-Cola, Dell, Microsoft, right? American companies. You have below that, in the little sort of tan pie, emerging market equities. That means countries in developing economies. So Brazil, China, right? India, Egypt. So next to that, you have in the brown pie, you have REITs. What is a REIT? Real estate investment trusts. That's what I was talking about earlier. It is a way to invest in real estate without actually having to buy a piece of land or buy a house. You can actually buy shares in a fund that's based on real estate. So he was very bullish on REITs, you can see. Government bonds is the red one. That's a small slice at 15%. And treasuries, that's a type of government bond. And he was, again, so if you add this up, you have 30% bonds between the treasuries and the government, right? And then you have 70%,
Yeah.
right, in equities. So we're going to see on the next slide that means, remember, equities are a lot more risky than debt, than bonds, right? Equities and debt, stocks and bonds. And so he had quite an aggressive portfolio. We're going to see on the next slide that this was a pretty aggressive growth portfolio. And that's why he did so well for us.
Elizabeth, we're getting quite a few questions, and I know it's 8:10, so just want to make sure we get to some of those questions. I think one touches a bit on this, which is, what about robo investment accounts? provide some context around that and just how that fits into the scheme, the broad scheme of things. There's a question that also touches on difference between mutual funds, ETFs, and index funds. You know, providing some colored context commentary on that would be helpful.
Okay, so I'll start with the second question first. Mutual funds, ETFs, and index funds, I'm going to talk about in the next chat next month in May, because they will, it'll make more sense in the context of retirement planning. You know, because most tax advantaged retirement accounts, 401ks, 403bs, IRAs, they are invested in funds, whether they be mutual funds, index funds, ETFs, right? Or investment trusts even. So I'm going to leave that until May to talk about. Robo investing is, I mean, you know, what can I say? Okay, if you are really sophisticated and about investing and about personal money management, then robo investing might be a great thing. I don't know. Albert, for example, has been investing for a number of years now. And do you use robo investing sites, Albert?
No, I do not.
Do you not? Why? Maybe, you know, but I know why I wouldn't recommend it, but I'm, you know, I'm a sort of a traditional, I work traditionally with people. I like working one-on-one. I think my philosophy here is that everyone's financial situation is really unique, is very different. We come from different places. We have different relationships to money. We have different levels of understanding. And so to use an app that is going to use algorithms based on a very superficial understanding of what the structure of your finances is scary to me. I would never recommend it. I think that, you know, one is really best served reading as much as possible and getting help to make critical decisions early enough in your life so that your plan, your investment plan, I mean, it's critical. You can't prosper unless you plan. And I would recommend everyone get the kind of help that is going to enable them to create a flexible, long-term investment plan. And you're not really going to get that with robo investing.
Sounds good.
Yeah.
Next question we have is crypto, right? Should crypto be considered another high volatile asset class? Just would love to get your perspectives on crypto. It's such the buzz right now. And quite frankly, I have friends who've made quite a bit of money, and that makes me wonder if I'm missing out.
Yes, FOMO. We all have FOMO around crypto. I'm going to be honest. I have a small cryptocurrency portfolio. I believe very much in the underlying technology, blockchain. Blockchain is revolutionary. And I think, so cryptocurrencies is different than blockchain, right? Cryptocurrencies use the technology of blockchain, but they are not blockchain. And I think that we have only begun to scratch the surface of the types of applications that will be enabled by blockchain. But I do think that the craze around cryptocurrencies as currencies is overblown and is not based on value. And I only really work with people who want to create value in the traditional markets. So what I can say is if you are doing really, really, really well and you have an extra couple of thousand that you can kind of throw away, that's gambling, then okay. But I would never include it in a traditional portfolio for anyone that asked my advice.
Sounds
I think
great.
it's fun, but I think it's fun. So I mean, I dabble, but that's money that, you know, is not a critical part of my investment plan.
Great. The other question we have is around REITs. Just, getting your perspective on the rate of return for REITs and how best to invest in REITs.
I think they're fabulous. I've got money in REITs, and I believe in real estate, particularly as an asset that will hedge other asset classes. REITs are a kind of mutual fund. It's not difficult to get information on them. And again, I mean, I will talk in more detail about specific types of investments in the next in our next session. This session is really about understanding the markets in general, how they work, why they exist, and what the risks are, and how to manage some of the risks. In terms of REITs, please, whoever's asking this question, please don't hesitate. Contact me. I can talk to you individually about REITs because I'm bullish on REITs, and we can point you in the right direction for how to do some research around getting into some good ones.
All right, good. So we've gotten the nudge for you to continue to finish on the market. So we'll pause and hold off questions, but please submit your questions in the chat. And as those come up, we'll direct it to Elisabeth. Elisabeth,
Okay.
over to you.
Okay, so we see here, so we just talked about portfolios, and now we want to talk about how to construct a portfolio according to your risk profile. Albert spoke earlier about he has quite an appetite for risk. He's sort of has his portfolio designed to grow aggressively, which means he takes on a lot of risk. We saw that David Swenson did about 30% in bonds and 70% in stocks, right? And all different kinds of stocks and different kinds of bonds. We have here what are considered to be very traditional growth models. You have a conservative profile, a conservative portfolio, which grows conservatively at 80% bonds and 20% stocks. Conservative, moderate conservative, 60% 40, moderate growth, 60-40 the opposite. I'm sorry, the equity is the red and debt is the green. You have a solid growth, which is I think what Albert says he does. Albert, is that correct?
I prefer solid growth, but I also recently been more into aggressive growth.
Really? More aggressive growth. So you're talking 100% equities in your portfolio at the moment?
Yeah, exactly. I am keeping an eye on different kinds of bonds options, but for now, I have definitely been on the more aggressive growth side. Being a college student right now, I have the luxury of Yale paying for a lot of the expenses, and so I decided that aggressive growth strategy may serve me better in the long term.
Right. Don't we all wish that we had Albert's knowledge way back when? Okay, so I'm going to go on to the next slide just because we're running out of time, but also I want to show you what this risk thing means. Oh, actually, you know what? I'm going to go to the next slide because I want to talk about this. Yes, risk. I'll maybe circle back to the former slide. But here, I want to talk about risk profiles. So Albert's been talking about how he has an appetite for aggressive growth. And we saw how some portfolios are constructed conservatively and some are constructed moderately. What does all that mean for us as investors? It is imperative that when we start investing in the market, that we develop a very clear idea of what our risk profile is. And what makes up a risk profile? Well, there are four basic things. One is your risk requirement. What is that? A risk requirement is, it's financially based, okay? And it means, how much risk do I need to take in order to achieve my goal? And we're going to talk more about that in May, in our next session, when we're talking about retirement planning or college savings planning. Because sometimes you need to have a certain amount of money in a certain amount of years, right? And you need to figure out, if you have this much money today and you're able to save this much money on a yearly basis up until then, at what rate does that money need to grow for you to reach your goal, right? So how much risk do I need to take? Risk capacity, this is also a financial consideration. This is, how much risk can I actually afford to take? So Albert was just saying, you know what, I'm a student, Yale's paying a lot of my expenses, I can afford to take a lot of risk. So he has a large capacity, financial capacity for risk. But what if you have your first job, you're married, you have a child, you just bought a house, you have a mortgage, you know, you have a lot of expenses, you're saving already for college for that child. Well, do you actually have the capacity to take on risk? Can you afford to lose money, right? So that's the second part of the finance stuff. The other side of risk profiling is psychological and emotional. So in the blue, we see, what is your risk tolerance? Well, that's psychological. What is your character like? What is your personality like? This is a personality thing. I mean, some people have an iron stomach and they can watch that market go, and just, some people at the first dip, right? And you have to know that about yourself, because if that's who you are, then you can't have a 100% growth portfolio like Albert does, right? Risk appetite. Now, this is a very interesting aspect of risk. It's emotional. It's not psychological. It is, how much risk are you willing to take? Are you willing to be a bungee jumper, but then when you get there, you can't do it? Do you like to think of yourself as really risk-taking, but when the market dips, you run for cover? And so being really realistic and honest with ourselves about what our risk appetite actually is, what our tolerance is, these will help us construct portfolios. Let me go back to here. According to how much risk we really can take. All right? Let me just quickly do this last slide. This is quickly, I talked about the two major risks, right? Volatility and loss of capital in the market. And we talked about 4 basic strategies for mitigating those risks, right? And one of them was a diversified portfolio, right? Structured according to your risk profile. Well, I don't know if anybody, thought about this, but over time, let's say we've decided on an allocation. On the left, you're going to see there's 4 pieces of pie, each 25%. It doesn't really matter what the assets are. We've got domestic shares, domestic bonds, emerging markets, and global shares, whatever. The important thing to see in that slide there, in that graph, is 25, 25, 25, and 25. So your asset allocation is equally divided between 4 asset classes. Over time, what's going to happen in the market? What's going to happen is that some of those asset classes are going to perform really well, and some of them aren't. So if we look in the middle, at the middle graph, we see on the left-hand side 37%. Those are domestic equities, Coca-Cola, Dell, Microsoft, right? You can see that it's performed really well. It's gone from 25% to 37% over, let's say, over the course of 5 years or something. If you continue to allow your portfolio to keep growing in this way, what happens is that you are losing your original risk profile, the original risk allocation, because now all of a sudden in this middle one, this middle graph, you're taking much more risk. Remember, shares are much riskier than bonds. Bonds have moved from 25 to 15%. They haven't done very well. And if you do nothing to this portfolio, what's happening is that you are actually in a portfolio that is not matching your risk allocation, your original allocation. So what do you have to do? You have to rebalance it. You regularly bring the portfolio back to your original allocation. And because as assets perform differently over time, your asset allocation is going to change. And most of the times this is done automatically. An advisor will do it for you. Albert, do you rebalance your portfolio yourself?
Yes, I like to rebalance every quarter, just
Yeah.
looking at how the different allocations.
Right. So Albert is doing it right. It is recommended that one rebalances quarterly.
So,
And you
Elizabeth, we have a few more questions. Hoping we can get to those before the end of the session.
Okay, well, I'm finished. I mean, that was really that was it. That was my last point that I wanted to make, is make sure that you're thinking about rebalancing that diversified portfolio.
So the one question we have is, how can you hedge against inflation? Any recommendations there?
Yeah, the best hedge against inflation is equity, investing in the stock market. Oop, I think we've lost Philaki for a minute.
Sorry, I had to mute myself. My dog was getting a little frisky.
Oh.
Great. The other question has to do with I bonds. It looks like that's trending. Any points or views on that one?
Yeah, I think in fact, Albert and I had a long discussion about I bonds recently. Albert said, what do you think? And I said, well, what do you think? And Albert why don't you talk about it, Albert? Why don't you take that question?
Yeah, so I definitely understand people's skepticism with the 7.13% rate right now. And what that really means is you're earning 7.13% interest semi-annually. And it readjusts every 6 months from the day you get your rate. And so people are definitely concerned about, what are the penalty fees that you're going to incur if you withdraw early. So typically there's a penalty fee if you withdraw within 5 years and you lose the last 3 months of your payment. But if you do the calculations to measure out what the true interest rate is, so taking in consideration this withdrawal fee, it is still substantially higher than the kind of interest rates that you can get from savings accounts, which are, at a measly 0.65% at best.
So Albert, could you tell the audience what you're using the bonds for?
Yeah, so typically I like to use the bonds as a way of like storing my emergency fund. I'm not someone who likes to keep a lot of money in checkings accounts because, like you said, there's a very high inflation rate right now. But also in terms of thinking long term, I want to keep my portfolio somewhat balanced, even if I have a very aggressive portfolio now. I think one thing to think about when you're trying to allocate your portfolio is that your appetite changes over time. And you want to set yourself up for success so that when your appetite does become more conservative, that when you're readjusting your portfolio, you can do so.
Great.
Right. So one last question, and I think we need to wrap up. It's how do you rebalance? How often do you rebalance an active equity portfolio? Any tips and information on that?
Albert, you want to take that?
Yeah, sure. So generally speaking, you don't want to, reallocate your portfolio very often. Every time you do so, you may incur some, capital gains tax if you're selling stuff off. But one thing I would, say is a good kind of rule of thumb is just to look at it quarterly and see how you can adjust there. When you're adjusting, you also want to think about how your risk appetite is changing quarter to quarter and see, where do you stand emotionally and whether or not you'll be able to stomach some kind of fluctuation in the market. I know for me, I try to try to take the emotions out of investing as much as possible, but it definitely is a little hard to sleep at night when you see, big falls in the market. But you just have to remind yourself that when you're reallocating, that you really want to stick to the original plan you have.
Oh, well
Right.
said. Stick to the original plan, long term.
Lovely. Well, we are at 8:31, so want to be respectful of everyone's time. Elisabeth, Albert, thank you so much for taking time out of your schedules to really educate us and give us the opportunity to ask you these questions. We're very excited about what you have in store for the next session. And for those who have not already registered, please look out for the link to do so. Keep your questions coming. I know there were questions we didn't get to, but please share and we'll make sure we get you the information that you need to continue to prosper in everything that you do. Well, thanks all.
Please
And
feel free to contact Albert and me. Please feel free. We're happy to engage and to provide whatever support we can.
And on behalf of 1stGenYale, I want to thank Elisabeth, Philaki, and Albert for your wonderful presentation today. And we look forward to seeing everyone again on May 26th for retirement strategies. So stay tuned and you'll see the invitation through your various social media. I also put it in the chat with the direct link. So thank you and good night and have a wonderful evening.